Hello, everybody, and welcome to this edition of the Speeki webinar series. My name is Scott Lane, and I'm going to be the host for today's webinar. Firstly, for those of you that have not attended one of our webinars before, what you will find is that the webinar is a 30-minute program, which is designed to take a particular topic around ESG or compliance or governance and to dig into it as quickly as possible to give you as much information as we can within 30 minutes in order to get you along the path of implementing part of an ESG program. Today, we're focused on ESG metrics and specifically how to measure those aspects of your ESG program and how it provides value back to your stakeholders. So it's quite a large topic. So without delaying any further, we're going to get straight into it. Like all the Speeki webinars, we will give you a 5-step process that you can follow to try and look at this topic and grasp it a little bit quickly so the benefit of your programs. So firstly, why are we doing this topic? Firstly, there's a couple of reasons why I think it's very important to focus on metrics. Now, the main reason is because these people expect you to have metrics and they want to see how you're going with your ESG program. So at its very most simplest form, it's because these people expect you to have them. Investors want to know how your ESG program is going. Those investors have their own obligations to report ESG issues to their investors. Employees want to know. People want to work for organizations that are performing well. They want to know. Customers want to know. We know that in this new world of ESG, and particularly with sustainability and human rights and workplace issues, customers are increasingly focused on ESG issues. In 38 countries right now, with over 2,000 obligations, governments are requiring you to report out information about your ESG programs. I expect that 38 countries is going to increase significantly over the next 12 months, and the number of requirements to report out is going to increase substantially. The other reasons is because the business expects you to. The business, like anyone else, is here to make profit. Leaving aside charitable operations, businesses are there to provide value back to their shareholders. The business management invest money in you and your programs, and they expect a return. They expect a return on that investment. So it's not unreasonable that we need to create these metrics for the very simple requirement of providing that information to our executives that are entrusting us with funds in order to build programs to add value. Now, to dig a little bit deeper on that, the question is, well, why are we looking at metrics? And firstly, metrics are really here for these 5 reasons. Firstly, they provide great insight. And we're going to discuss a little bit more, a little bit further in the webinar about how to use metrics to identify key risk areas or areas of focus. The other thing that metrics do for you is they get you to prioritize. When you see a set of metrics, you immediately will focus on the one that you need to improve, and that will help you prioritize. Metrics, by their own definition, is really focused on setting targets and goals. So in addition to giving you that prioritization element, they also provide this mechanism of goals. Metrics also assign accountability. By their very nature, by setting a goal and measuring it with some form of metric, you're setting up a system of accountability and responsibility so that someone owns those metrics and they own the impact of those metrics. And of course, with all things ESG, you want to measure the impact of what you're doing, the impact on stakeholders, the impact on the very people that I talked about, customers, employees, partners, suppliers, and of course, people who have invested in your business. So there's some very simple reasons why metrics are actually valuable and you need to focus on them. Now, to give you a few more examples, let's think about metrics around financial metrics. So if we were to look at some financial metrics around ESG, what's the return on our investment of ESG? What do those financial metrics do? Well, the recipients of those financial metrics, the people that look at them and read them and understand them, are going to be engaged as a result of those metrics. Those metrics can strengthen the leadership commitment that leadership gives to the ESG program. Those metrics may give rise to you receiving additional resources, or it may help people adapt and change to a particular position or goal or objective that you've set aside as part of your program. So the very nature of building metrics has not only the measurable element of the metric, but it also has these intended consequences that are on the screen. Another example is focused on things like metrics around equality or fairness. If you're focusing on metrics as part of your ESG program, again, the intended consequence is not only a goal or an objective, but the very nature that you have a metric and you're measuring it builds trust. It builds trust with employees, it fosters satisfaction and achievement, and also drives commitment by the people that are actually receiving and seeing those metrics. And of course, building those metrics about fairness and equality goes towards strengthening your brand. So when you look at metrics, you're not only thinking about the goals and objectives concept of what a metric does and what it measures, but you're also having to think about the intended consequences. And I say that intentionally, that they're intended consequences, because they are. Those softer consequences of a metric and how you display a metric to your stakeholders has some real consequences. So now that we've looked at the why are we doing metrics, let's look at what metrics actually are in terms of an ESG program. Now, this is a very big dialogue, which you could have, frankly, for a day, which we're going to do in a few minutes. There are three different types of metrics that I like to look at. I'm going to take you through the different types of these metrics. Now, I'm going to use diversity as an example. Most of us have the concepts of diversity. We understand diversity, equity, and inclusion, and we understand how that works in an organization. So as we go through the examples of the different types of metrics, keep in mind the concept of diversity. So keep in mind some of the classic diversity metrics that you might already know or measure as part of your program. Again, we could have chosen any one of the ESG risk areas. I chose diversity as part of this example. So the first classification, or the first category of metrics, I like to call metrics for diagnosis. So these are the metrics that they're a statement of facts. They're facts about a particular program. So let's look at diversity. Metrics might be representation metrics. So that is, how is our workforce represented by way of gender or by way of race? It might be questions of fact about retention. How are we retaining staff? The percentage of male staff that we retain versus female staff, to use a gender example. It might be looking at statements of fact around recruitment, selection, development, promotion, pay, or benefits. The point of all of these metrics is that they're there to reflect a statement of fact, a baseline, a true position. Now, what do these metrics tell you? They enable you to diagnose blind spots. That's what they're there for. So if you're looking at a particular metric that says you're 70% male, but 30% female in your workforce, that metric might tell you something. And it might tell you something in the context of your customer base, which might be 50-50. Think of it as a sales team. You've got a buyer, your customers, 50-50, male, female, but your sales force might be 70-30. So when you think about the first category of metrics, what you're really thinking about is those diagnostic metrics. You're saying, what are the basic principles that are relevant for this risk area, and you're thinking about how to identify the blind spots. What are these metrics telling us? So the first category about metrics is the diagnostic metrics, statements of fact. Let's move on to the second category, which are metrics that focus on tracking progress. Now, as you might expect, these are metrics that move over time. What they do is they look at the baseline that we just looked at, so for example, gender equality, and they take into account the fact that you have built programs to change those metrics or to improve those metrics. So to use the example of gender equality, you might have a 70-30 split between, let's say, male and female in your sales force. And you've identified that you think that should be different. And the reason you think that it should be different is because your customer base is 50-50. And you want to be able to see the opportunities of improving your mix of gender in your sales team to try and reflect better your customers. So a tracking metric is about how you're improving over time. You were 70-30, now you're 60-40, 55-45. So it is a progression of metrics over time. So that's what tracking metrics are all about. Now, what they do is they're really driven towards some sort of goal or objective. So you've set aside where you are now and you're working towards a goal or objective. So the second category of metric is all about how do you focus on tracking the changes in those metrics. Now, the third category of metrics that I like to look at are the return on investment metrics. Now, these are the most challenging and the most difficult, but in my view, they are by far the most valuable. These are the metrics that really look at how the ESG goals, or the objectives, the metrics that you've set, how they map to the business goals. And we're going to talk a little bit more about this in this webinar about how business goals and the metrics mapping to the business goals are really important and how to achieve it. So the third category is ROI metrics, return on investment. Now, these are not always financial, but they are very often financial, and they are often reflected as a dollar value. So let's use our example. Let's say we identified that the current baseline, metric number one, was that we had a 70-30 split of gender. But we identified that our customer base was 50-50. And so we set a goal to try and move towards 50-50. Great. So that's category number one of the metric, and category number two of the metric set aside. So how do we measure category three, the metrics for the return on the investment? Now, what this involves is standing back and saying, what are we missing now by having a 70-30 split versus our customers who are 50-50? Now, in my example, that might be saying, what female customers are we not attracting because of our mix of sales force? Give you another example. Let's talk about products. Let's say we manufacture shoes or clothing, but we only manufacture clothes for a certain gender. We only make female clothes. And we've decided that one of the things we're going to focus on is becoming more diverse in our product suite so that we can attract a broader audience. So what are we missing in our opportunities right now versus where we can get to if we change our product mix based on our customer and based on our current genders? So whichever way you look at it, or whatever metric that you're looking at, the return on the investment is either going to be in a financial term, if you can equate it to real dollars, or it's going to be in value to the business measured some other way. More customers, more market share, perhaps more margin. So they're the three types of metrics that I encourage you to think about as you're building your program around measuring and metrics. Three different classifications or categories of metric. So now we've looked at the why and we've looked at the what. Let's look at the who. Why are we creating these metrics and who are we creating them for? Firstly, every metric that you produce is going to mean something to a different audience. So part of ESG involves looking at your stakeholders and saying, who are the stakeholders of this business as it applies to ESG? And how can we set programs to leverage the ESG programs to benefit those stakeholders? What do those stakeholders expect of us? On the screen, you have investors, executives, and suppliers. And we've set out very simply, what are the things that these three groups care about? What do investors care about? Investors care about the share price, frankly. Investors bought shares for $1 and they hope that those shares go up in value and they're worth more than $1 in a short period of time. That's what they care about. Some investors may care about dividends, but what they're talking about is typically a financial return. That's what most investors care. Executives. What do executives of companies care about? Frankly, what they care about is they care about the stock price too, the valuation of the business, market share, customers. They care about the size of their margins. That's what they care about. That's what executives care about. Same with vendors and suppliers. So as you go through the different audiences that you're speaking with, and again, you can look at employees or customers or community, the value, the definition of value of the ESG program to those audiences is going to be very different. Now, employees, for example, they care about working conditions. They care about how the ESG program will help them with diversity. They care about how they will feel safer in the workplace. They will care about their pay and benefits and fairness and equality. That's what they care about. So if you're building a set of metrics, you need to keep in mind the audience who are going to see those metrics. And it is absolutely intelligent to map the metric that you're building and communicate certain metrics to certain audiences. There is no point wasting time talking about the financial numbers to an audience that doesn't find that of value to them as it applies to ESG. Likewise, going to the shareholders and telling them about your major achievements in getting diversity across gender, for example, unless you can equate that to an ROI, most of those investors couldn't care less. They don't want to see that in your report. That's not interesting to them. But if you tell your investor how you're driving the share price or how you're driving share value or how you're driving profitability because you've got ROI based on the initiative that you're driving in ESG, now I'm interested. So the message is to make sure that when you are building your metrics, you know what the metric is, and you know to whom you are going to communicate a specific metric. And do not waste time or energy reporting metrics to people where they find it irrelevant based on what their value proposition is of ESG. So we've looked at the 4 groups so far. Now we're going to be looking at the next step, which is how. How do you determine what metrics to show to what audience? So remember, we've focused so far on working out what metrics are. We've worked out what the different categories of metrics are, and we've worked out what our audience is. And now we need to work out how do we map those elements together so that we're communicating the right metric to the right audience at the right time. Now, I need to have a bit of a disclaimer here to say that there is no magic set of metrics. If you were coming onto this webinar and saying, I hope that Scott gives me a bunch of dashboards and a bunch of metrics and I can lift those and basically copy them, the answer is there is not a set of metrics. There is not a set of agreed principles that you are required to have by law or regulation or best practice that set aside your metrics. There will be some commonality across most companies, but it is absolutely expected that every company needs to build its metrics according to what's relevant to you, what's relevant to your company. So the first disclaimer is there is no silver bullet here when it comes to metrics. However, there's a step that you can follow. Now, one of the things that we've built at Speeki is what we call the Engage framework or the Engage methodology, and it's seen on the screen. Now, I've talked about this in previous webinars. It looks a little scary at first glance, but actually it's not. What it's saying to you is start at the center, and before you start really building your programs, stand back a little bit and think about, what is your company? What's the point of this company? What's its purpose? What's its values? What's it trying to achieve? What is ESG here for? Why are we building ESG? What ESG laws require us to report out or require us to report to our stakeholders? Who are our stakeholders? And what's our clear strategy around developing ESG with respect to this business? And if you work on those 2 or 3 little circles at the center of the ESG framework, you'll find very quickly that it will help you identify what is important to your company, what is important to your stakeholders, what's important to your business, and it will help you start to then work out what are the key drivers that you've got to build in your ESG program, which will add value that your stakeholders want to know about. So use the framework. The framework is designed to help you step by step think through some of these issues. And I encourage you, if you haven't spent time on this framework or you need help understanding it, go to one of our academies to understand how to apply it in practice. Here are the 5 steps. Number 1, first thing you need to do is define the dimension that you're going to measure. So first step on establishing metrics is working out, based on the risk model that you have, the risk areas that you have that form part of your definition of ESG, what are the areas that you are going to focus on in terms of dimensions? Is it, for example, diversity that we've just talked about? Because diversity is a key risk area and it's something that you need to focus on and improve because your stakeholders expect it or because it's required by law. Or are you going to be focused on anti-corruption? Or are you going to be focused on green energy or waste management? What is it that you're going to focus on as part of your metrics around ESG? First step that you need to work on. Moving on to number 2, you've got to work out why you're creating these metrics. So again, think about the types of metrics. Are you building metrics, which is the current state? Are you building metrics to try and diagnose issues and work out where you need to focus? Are you building metrics in order to track improvement against goals or objectives? Or are you at the stage where you're trying to predict return on investment? You're doing some quick wins, some low-hanging fruit to try and show that the efforts that you've done may contribute to the actual value proposition for the business. So you need to work out what are the different classification or the categories of metrics that you want to apply to the business. So that's the second step that you really need to work through. Keep in mind here that, for example, diversity programs, you may be focused on the first category, diagnosis. But for other programs, you may be focused on ROI. Those programs are more advanced. They're easier to calculate a value proposition. So again, multiple different risk areas may apply different categories of metrics. Third step, now that you've worked out what you're going to do, you need to work out your audience. You need to work out what is the audience that I'm going to present these metrics to. And keep in mind that different metrics will apply to different audiences. Don't waste everyone's time giving them information that they cannot absorb or they do not understand or is totally irrelevant to them. So many times I see metrics put together that is this huge amount of dashboards or information meant for audiences that find it totally, utterly irrelevant. It doesn't apply to them. And what that means is when you start talking to the wrong audience about the wrong metrics, people get frustrated. They don't see value, don't see buy-in. They don't understand how this is in it for me. They don't understand how this applies to them. And you lose their trust. You lose their buy-in. So unless you communicate in a language that the stakeholder can understand, and the metrics is that language, you're going to lose them. And stakeholder management and keeping that buy-in is an essential part of ESG because it's tough and it's hard to keep that momentum. So step number 3, focus on who the audience is. Number 4, again, you've got to work out, now that you've identified the metric, how are you going to get the data? You've identified these fantastic metrics, and the answer is that's terrific, that's great. Now you actually have to do things in order to work out how to measure something in order to gain that metric. So number 4 is all about how do you get the baseline, the goals, how do you implement things, measure things, all the things that you need to do. It's the operational element of your programs so that you can actually get the results, so that you can actually measure change over time. Finally, once you've got your metrics, you've measured them, you've categorized them, you've worked out your audience, you've built your programs, you're communicating them. Now you need to work on, are they effective or not? Are they the right metrics? We recommend at Speeki at least an annual review of those metrics to see whether or not they're still relevant, they're still useful, whether or not they're still adding value to you, to get the feedback from the recipients, the audience, and see what they think about these metrics. So step number 5 is really that calculation process to determine, are we on the right track? And then you go back to step number 1 again. All part of the definition of how we manage the metrics associated with ESG. So what are some of the key messages that I want to leave you with in the last few minutes? Firstly, these 3, there are different types of metrics. There are different categories of metrics that are going to be relevant for different types of audiences. And thirdly, take the time to really think through and improve those metrics over time. Again, we're talking about the concept of the metrics, not the results of the metrics. That's something that your programs will do based on goals and objectives. But remember that different metrics are meant for different people, and they can be different across different risk areas. So stand back and think about what's the objective of the metric and how are you trying to communicate that objective to your stakeholders. Finally, if all this seems a bit too much and you want some more information, Speeki obviously can provide you with some assistance. And one of those things is to attend one of our academies where you can learn a little bit more about these issues. The next one is coming up in London. It's a public academy, meaning it's something where you can join. It is a paid event, and so it will be an event where you'll have multiple companies attending this event. We also do academies in-house. So if you want to get your teams together and do them for half day, 1 day, 2 day, 3 days in one location with your teams to work through it as a group session and really push through the understanding and learning a lot faster, there's in-house options for you as well. So wrapping up, that's the final part of our discussion today and our webinar. As always, if you do have questions or follow-up, often we won't have time to answer it on today, but you're welcome to send those through to the team or through to the chatbot. I will get those answers back to you as quickly as I can and give you some more guidance. This is obviously being recorded and you'll be able to access it on the live Storm system, and you're welcome to invite people in order to see it as well. So from me, thank you very much for attending this edition of the Speeki webinars, and we look forward to seeing you at the next edition in about 1 month's time. Thanks very much, everyone. Bye-bye.